Bob Dole was with us, one of the most respected and recognized names in investment management. And I thought it was fascinating, Kyle, that he walked us through kind of his theory of markets, how he addresses investing, and also some comments on where the markets are going to go in the future.
Yeah, well, he's been everywhere. So he was at Merrill Lynch, then he went to BlackRock, then Nuveen, and now he's at Crossmark, CEO and Chief Investment Officer, more of a values-based called investment manager. He's got a playbook. He's got what he knows is his 50-point quantitative analysis on how he does portfolio management. Really in the weeds, but a great conversation around economics and business as a whole.
He had a lot of enthusiasm and a lot of technical knowledge. So it's a fun listen.
Welcome to Intersections, where we take a multi-generational look at the critical issues facing America. Tom, kick us off.
We're fortunate to have Bob Dole. Bob Dole is probably one of the more recognized and more respected investment managers in this nation. We will go through some of the houses that he's been at, and they are the leading names in investment. He's currently the president, CEO, and CIO, Chief Investment Officer, at Crossmark, which we'll think will be an interesting conversation just on that organization by itself.
Absolutely.
We'll have a good one.
Yeah. So we're going to just kind of jump right into it.
Let's do it.
We know, you went to Lehigh and you got into the finance world. So take us through the early stages of your career. What were the challenges starting out? How did you get started in finance? And
why investing? What was the initial attraction?
So I loved numbers and was always good with them, whatever that means. So I was a math major until sophomore year. The only numbers in the textbook were the page numbers. It was all Greek symbols. I said, this is not what I had in mind. So I needed applied math. So quantitative research, finance, industrial engineering, operations research. Fortunately, I was at a university where I could get a smattering of that. Lehigh's a university, not a college. So that's sort of the background of the numbers, if you will. Jump forward, after undergraduate school, I spent 2 years in public accounting. I knew I wanted to get my MBA, and the wisdom was don't pile business on top of business. Go see what's out there for a bit. Well, I was dating a girl during those in-between years. I didn't fall in love with her, but I fell in love with what her father did for a living. He was an investor. My parents didn't have any money, so we had no stocks. I didn't know what the stock market was, but I fell in love. And this was a calling by God, if you will, on my life, my career. Math, finance, economics, psychology, politics, and you can read your score in the newspaper every day. It's like a sport. So I just fell in love and have been doing it ever since.
Love it.
So when you went to Wharton, did you know you wanted to go to the investing side of it?
Absolutely. On discovering what that was, I knew I was going to focus on, concentrate on finance and within that investment management. Yes.
I've had a chance to visit with a lot of investment managers over the years. And you touched on some things because there's different motivations. I've kind of seen that. Some, it's the competitive side. Some, which you mentioned, is I'm able to see my scorecard in the paper every single day.
And now during the day.
Yes. Yeah. But then there's also the piece of kind of the fascinating of understanding how companies work, kind of being the future predictor, so to speak. And then you've got all of kind of the political, geopolitical, and all the economic questions that go into it at the same time. All those pieces of the equation?
All of it. All of it. And part of the reason, Tom, is it's a variety and therefore it's never boring. No 2 days are the same. The moment you think you figured it out, the market smacks you in the face and you get it wrong. So it's never ending. As one of my friends says, it beats working for a living. There's no heavy lifting and it's indoor work.
Sure. So coming out of Wharton, what did you think you were going to do in the finance world versus what you have since done?
So I wanted to be a portfolio manager, large cap U.S. equities. And within
and
nonstop, I've had opportunities for management and leadership, but I have never given up managing money. That's my trade, if you will. That's my cred, if you will. And that's what I enjoy doing the most. The CIO stuff, the CEO stuff, been there, done that, and I'm okay at it, but give me a portfolio.
Yep. And in a sense, you've done that in every one of the positions that you've been in, pretty significant ones.
Correct.
But the houses have been very different.
Boy, have they.
Oppenheimer,
Yes.
BlackRock,
Yes.
Nuveen, and now Crossmark. Spend a little bit of time of, again, you're doing the same thing, money trying to generate a return, regardless of what it is, but the cultures of each of those different organizations and what you got out of them.
Yeah. So you're right to say, I did the same job in a sense at each one, trying to beat the market, the S&P 500, or more recent decades, the Russell 1000.
Mm-hmm.
And no matter where you are, that's the challenge, and that's the mark of what you're going to deliver to your clients. But you're absolutely right. The process inside of it, the people, the interaction, the culture, to use your word, very different firm by firm. I started Citicorp Investment Management right out of school, spent 7 years there, 2 as an analyst, got an opportunity to be a junior portfolio manager, grabbed it, and never stopped. In some sense, I'm doing the same job I was doing in my 3rd year. Hopefully doing it a little better with a little more smarts, a little more experience. But so then I went to the Oppenheimer funds where I had my own mutual funds. And that was a growth culture. Those were the salad days of the investment management business. It was small. We weren't very regulated, and we grew. When I joined, we were $7 billion in size, and the CEO established a goal, $100 billion and better. And before I left, we got to $100 billion. It was the growth.
7 to 100 is a pretty good number.
It's a pretty good swing. Absolutely right.
So before we jump into the other houses, walk our audience through, what does a portfolio manager do day in, day out? When you say you have mutual funds,
right? What's
tell
that
us
mean?
about it. Yeah.
I'll give it to the present day. Every morning at 4:55 Eastern, my portfolios come across the internet. What does that mean? I'm able to look at the quantitative model that I've built and how the portfolios match up to that model or differ from it. That's the starting point. Okay, here's what the portfolio looks like today. Here's what the model suggests. We're conscious of that. We don't like that stock. The model does, but they're going to have a bad quarter. Or vice versa. Boy, this quantitative model, it tells us where we should spend our time because the names toward the top outperform the names toward the bottom. Not every day, but over time and most of the time. And therefore, the job is to figure out how I'm going to morph my portfolio from where it is to where it might be by selling this stock and buying that stock. And you don't do it with a piece of paper. You do it with some research, something you're finding out by talking to the company or meeting with the company, or an analyst gives you an input that helps you figure out, or gee, I don't have enough of those kind of stocks in my portfolio. Let me find one. That's the process. That's what you do.
How much of your, and you've had a lot of successes, I mentioned when I started. If you were to step back and say, here's the reason for my success.
Right.
And inherently, I'm kind of getting to a question that's an old investment manager one that says, how much of it is the algorithms and the numbers versus just the gut feel that this is the right move?
That differs investment professional to investment professional. I'm a quant. And so I want the numbers to tell me. That doesn't mean I don't care about the gut feel and the judgment call. I make those too, but it's always with a backdrop of the model that we've worked so hard to develop is pointing us in a direction. Other guys, they meet with a company and they, doodle on a piece of paper and they come up with an earnings model and they make a call or two and they buy the stock. It varies all over the place. Mine is more of a, I don't want to de-emphasize it too much, more of a cookbook. Okay. Now that's partly by necessity as I've taken on leadership and management responsibilities, which take time. I have to streamline and size. Yeah. I have to streamline the process around the portfolio.
On this model.
Yeah.
How much has that model changed from today versus a year ago?
Have you been an investment manager? So it started
because the way you describe it, it's this model that comes off the shelf, and all I need to do is do a couple of things and make it. I think it's a little bit more than that.
But some days you can do that, okay? You don't want to do that for too long because it can get stale. It started as a 2-factor model. I had it on a spreadsheet manual. It was a dividend discount model for the value variable and an earnings momentum variable for the growth factor.
So those were the two factors
that
you point to that said, above all things else, that's my primary.
And back
another
when
investment manager might have had,
something different.
Yeah, book value, et cetera, a whole host of
absolutely right. And back in the day, in the dark ages, when I started in this business, it worked. Now, the world's gotten a whole lot more sophisticated. So now it's more than 50 variables. It's on a pretty fancy computer program that I don't fully understand. I have quants who keep it for me, but I know what's going in and what's supposed to come out. So it's gotten more complicated to answer the question. And we're always tinkering with it. Always tinkering with it.
And of those 50, do you change the weighting?
Yes.
On a frequent basis?
Once a quarter, we re-optimize. We can almost push a button. It says, increase the weight to that factor, decrease the weight to that factor. Not by much, just little bits and pieces, because we always want it to be as fresh as possible.
Now,
and occasionally we find a new variable or a new tweak on an old variable. For example, not to get overly technical, but price momentum, the direction of the stock, has some predictive power. What we discovered through some research somebody else did, the first 11 months, rather than all 12, is more powerful than just taking the trailing 12 months. So we made that slight change in the model.
So how much of that redo of the model or the shifts over time is prospective, which is what you described? We look at history and find that history is now weighting it differently, or these factors have a different probability of indicating future success, versus I'm looking out to the future and I'm saying, by whatever environmental issues, either by company, by economy, or by other events, is going to push the weighting of that. So instead of simply being a mathematical adjustment, it becomes more of a subjective or qualitative assessment.
Yeah, there's always the overlay of the environment and the judgment call that one is making. This model is keeping pointing me in low PE stocks, and they're not working right now, so I'm not going to overdo low PE stocks, for example. Having said that, more basically, again, I'll oversimplify. What does the model try to identify? Stocks that are cheap, because cheap stocks beat expensive stocks over time. Companies with improving fundamentals, measured lots of different ways, beat companies with deteriorating fundamentals. So if we can find a cheap stock with improving fundamentals, chances are over time we're going to win.
So if I dumb this down,
I just did, but go ahead.
If I dumb this down, I want to buy low and sell high. Is that correct?
Can I write that down?
Yeah. Is that good investment advice?
It's good investment advice.
That's actually one of the more insightful things he's had over the last,
Oh man, that's good.
I often, when I'm making a speech, I may end up with, I forgot, buy low, sell high. And when you figure it out, call me, because I haven't figured it out yet.
But you're in a competitive field.
Yes, very competitive. Very competitive.
You've got a lot of folks out there. So give us a feel for your model. You're working at that sort of thing.
Yep.
But everybody else's model and that sort of thing. What's the differentiating factor? How do you try to convey to clients? Because clearly you want clients to give you their money to invest under the premise that you're going to do better than the next guy. Yep. How do you sell that differentiation of model?
So first of all, you hope reputation. People know, follow, observe. Secondly, track record. Did it work? Or is this just a bunch of hot air? Thirdly, show me the discipline. I mean, you almost went there before. I almost jumped in. What's been one of the measures of success? Discipline. Just about the time you think you have a better answer than a model that you've worked on, you're going to get smacked in the face. Because I'm going to repeat, cheap stocks with improving fundamentals tend to outperform expensive stocks with deteriorating fundamentals. And that's all these 50 plus variables are trying to do.
So Bob, what you really said, it's fascinating to listen to you too, especially on that discipline piece, is I really want to pull the emotion out of it so that I don't get excited about, that CEO that's just kind of made the great speech and all the great things that are going to happen, may or may not happen. But you're pulling that emotion out and that judgment and really relying, again, back on the quantitative model. So it begs the question then of ETFs versus managed, where that's been and where do you think that's going?
Yeah. So first of all, you're absolutely right. My second guessing the model can get me into trouble. Sometimes it's the right thing to do, but I'd rather build it in the model based on quantitative and heuristics and back tests to be able to say, this does make sense, as opposed to, I woke up this morning and thought that can get me in a lot of trouble. And a lot of guys do that. Or the emotional part, you fall in love with a stock. The market goes down, that stock goes down. No, the stock's wrong. I'm going to get it right. Man, is that a mistake? And we all make it from time to time. So you try to take the emotion out of it and be objective as you possibly can.
So let's talk about your time at BlackRock.
Yeah.
You get there, you rise through the ranks. I think you end up being the chief equity strategist for the business. Talk to us about your time there, and then talk to us about your exit there and ultimately moving on to Nuveen and other things.
Yeah.
And give us a sense of the size of the portfolio at that time.
So
not inconsequential.
Backing up, I was CEO of Merrill Lynch's asset management business, MLIM, Merrill Lynch Investment Managers. BlackRock bought the asset management business of Merrill Lynch, and so I became a BlackRock employee that way. Needless to say, they didn't need another CEO. My job went. So I did become head of equities. And it was a big place. It grew like crazy. Cutthroat. Tough culture. I put my nose to the grindstone. Equities were headquartered in Princeton, New Jersey, so it wasn't always in the New York office, so I could stay away from the fray a bit. I think that allowed me to have sanity and last a little bit longer. So one day, the CEO came into my office and said, we found videos of you. 4 videos of me talking about faith issues, Christian college commencement speech, businessman's Christian group, etc. Not on company time, not on company premises. And they said you were introduced as a senior muckety-muck here, and then you talk to your church groups. We don't do that here. You will resign. Now, back up. Unless you have your hand in the cookie jar, it's usually far more complicated when you're a senior person somewhere, right? They didn't want me anymore. I didn't bleed the blood. I had a different faith, and they wanted to move on. I think maybe there was some jealousy. I had a really good relationship with the financial advisors, particularly at Merrill Lynch, because that's where we came from.
That's where you were.
And I think there was a little jealousy there. So I will tell you, a lot of people lose a lot of things worse than their job. But for me, it hit me between the eyes. I was not ready. I had lessons to learn, and I hopefully learned them, but I would not want to repeat 2012, but I wouldn't trade it for anything either.
Understand. Well, let's spend some time on that.
Yeah.
Today, in today's world, if somebody did that, I think it would beg a whole lot of legal issues.
Yeah.
And go, did you ever think of going down that path?
For a minute or two, I did. I talked to a lawyer. I had to get a lawyer, obviously. Didn't have one. And her advice to me was, this is New York. You probably wouldn't win. They may have to reinstate your job. They may owe you a bunch of money. But given the visibility of it, you're going to be in the Wall Street Journal every other day. And I said, you know what? I don't want that. They clearly don't want me. Let me move on.
Were you ready to move on?
No. I thought I was going to be there forever.
Sure.
I was working hard. I was contributing to the place. And, I'm a pretty loyal guy. So I didn't have any thoughts of leaving.
So talk about how the people around you reacted to that.
Yeah.
Because I assume that there were some people that were very close to you.
Yes.
That shared similar values.
Yes.
What did it do throughout the organization?
So what was, among other things, what was interesting is as I was leaving, who called and who didn't call.
Yeah.
Sure.
Some people called me. There's no way they're going to call me. And they did. What a joy that was. And the other people, where are they? I thought they were my buddies. So it was very interesting to play that out. Yeah, it was the part of the dog eat dog culture. I don't want to ding BlackRock too hard because they treated me well and I learned a lot there and a very successful company. But I still, obviously have some friends there, and usually I get something to the effect, I'm in a great place. We're a successful company. They're paying me a lot of money. I have a good job. But I really don't like going to work. I don't like the atmosphere. There's a lot of that going on. And I think it's gotten more difficult since I left.
That was a tough time. Somebody walks in and says, you're out of a job.
Yeah.
You clearly had performed very well, so it wasn't that.
Yes.
As you just kind of indicated to us, all of a sudden you go from the top to the bottom.
Right. Out on the street.
Yeah. Talk a little bit about how you dealt with that, how you communicated with your family.
With great difficulty.
That's a hole that's, for a lot of people that get in it, they never get out of it.
Yes, well said.
How'd you get out of it?
I think a whole bunch of reasons. People who cared for me, prayed for me, counseled me. I established a little board of 5 guys. 5 guys. We started before the train did. We had it. Those 5 guys, I knew them well for a long time, and I knew they
Any
would.
of them at BlackRock?
Sorry,
Any of them?
No, none of them were at BlackRock. Yeah, and I said, "Would you help me through this period till I get to wherever God's going to put me next?" And we had a lot of one-on-one conversations. The most interesting ones were all on the phone together. They forced me to write a couple of pages where I was, what I was thinking. That Tom helped get me through. The first call I got was from a Christian university. They needed a president. Why don't you be president of this university? Come, God, man, this would be great. I got influence on these students and make a difference.
Say what you want.
Say what I want.
Say what you want. Yeah,
maybe.
Maybe exactly.
And then my wife said, "And what percentage of your job would be fundraising?"
Yeah.
Oh yeah.
A little bit over 100.
Yeah, a little bit over 100, exactly. So I quickly came down from. I ended up going back to the same job I had before at a different place, smaller job, but with people I liked and trusted, and that was a good
What does
episode.
that say, though, about an organization that would, and again, there's a lot of things that are happening today in terms of freedom of speech, ability to say something and those sorts of things, cancel out.
Absolutely.
Kyle and I have talked about that. What does that say about the organization and its ability to compete in an environment where it's important in its investing,
right,
to have a lot of divergent opinions and to have opinions that sometimes
are different.
Really, call in the question you just asked. Well,
there's a lot of turnover at BlackRock and a lot of other investment organizations. Stability at the top, a lot of turnover underneath. This is the way they've built the place. Some people know that when they go in, that they're going to go in, and eventually they probably will go out. And that's just the way it is. Not my particular favorite kind of culture, but they've had amazing success. So, in the world's eyes, it's been pretty successful.
So how did you, very quickly moved into Nuveen.
Yeah.
So how did those conversations go on the front end?
Yeah.
When Nuveen asked the question, by the way.
Yeah, what happened?
You're at BlackRock.
What'd you do?
I told them.
But what was their reaction? Because I'm curious to contrast the two organizations. Because clearly one didn't like it, and one at least saw Bob Dole as a great asset.
Right. Most people were envious of, jealous of the success of BlackRock, but understood what the culture was like. Mm-hmm. And I probably scored a couple of points by not being there anymore. Oh, you got kicked out of there. Good for you.
That's like extra
2 more
crown.
points. Right? Yeah. Exactly. So, it was an interesting period. Yeah. I talked to a bunch of different firms. I mean, I talked to a lot of people. Obviously, I knew a lot of people in the business just to kind of figure out what's going to happen next.
So after coming off of that, why Nuveen then?
They needed a large cap manager. Mm-hmm. They were a Midwest firm founded by decades ago Christians. So there was a culture there that I could identify with. They liked me. I liked them. And I could tell it was a good organization. They had good investment performance, but it wasn't the meat grinder that I had come from. So I jumped in.
Yeah. So you do Nuveen.
Yeah.
And then Crossmark.
Yes.
And talk to us about what you do today and ultimately why, I guess you started out kind of as CIO, but now you've come back to being CEO.
Yeah.
What's the difference there inside that organization? How do you look at it?
So Crossmark is a faith-based money manager that creates and manages values-based products.
$5.5 billion-ish.
We're up to almost 8.
Oh, wow.
Yep, almost 8. And growing, thank the good Lord. What we try to do is just help people line that up. It's my biggest surprise in the 4.5 years I've been there is how much time I spent educating advisors and clients about what this possibility is to line up like you line up the rest of your business with what you believe. I sometimes use the illustration. Well, my wife could come to me and say, we could enhance our income if every third Thursday of the month we robbed a bank. Well, it doesn't fit with who we are, and somebody might catch us. So it's the same sort of thing. Why wouldn't you line up all of your life with what you believe? That's what it boils down to.
So you're really going to your clients' values as opposed to this is an investment strategy that produces a different set of return.
Thanks for bringing that up. First and foremost is investment performance. Over 40% of our products are ranked 4 or 5 stars by Morningstar. And that's a pretty high percentage. We pay our investment professionals based on how they do versus the whole universe. It can't be, well, us faith-based guys didn't do as, no. It's again, you got to beat everybody. And I would say, Tom, to answer that question, about a third of the money we manage is not values-based in any way, shape, or form. People come to us and say, you have good products, you have good performance, I like the service. Will you manage my money? So we are first and foremost a money manager, but we care about what we're trying to both avoid and give an extra kiss to.
I was going to ask this earlier, but I'll ask it now. You've been in a lot of different houses. You've seen a lot of different people. We talked about kind of simplifying it back to algorithms, but you hire people and some people succeed and some don't in the same environment. What makes a great investment manager?
Wow. Curiosity is the top of my list. Okay. When I interview people, that's what I want to see. Curious about everything. Because you never know where the next bit of information is going to come from to get you to make a decision that it could lead to some alpha creation for your clients. So that's the first and foremost. Yeah, you want education, you want experience, you want to see a track record. But if he's curious and you're not, I'm likely to hire him and not you. And curiosity comes out lots of different ways.
Yeah, sure.
Like, why does this office look this way? You know, why is stuff that's unrelated to the portfolio? I just want a curious person.
So let's dive into faith and work.
Yeah.
It's a topic near and dear to my heart, so I want to get your perspective on it. Give the audience a view of how you view money.
Yep.
Obviously, you're in the money business. That's what you do day in, day out. How that relates to your friends, your family,
yep,
and ultimately what you believe. And so start there. And then I want to just hear give the audience a little perspective on how you took your faith to work.
Yeah.
In a certain sense.
I start with a view, as many people do, that my money is not my money. Mm-hmm. It's God's money.
Yeah.
And if it's really my money, who cares what I do with it? But if it's God's money, now all of a sudden I have an awesome opportunity and responsibility to take good care of it. And then I can go on, if I can sermonize for a second, it's not just our money. It's our time, our bodies, our relationships. They're all from God. And so we're to be good stewards of all these things. That's where it started. I felt that for some time, but now I'm doing it full time, as it were. And it's just great because my worlds now are one, as opposed to, if I would mention Jesus in a meeting at BlackRock, what's wrong with him? Now, if I have a meeting, I don't mention Jesus, what's wrong with him? Yeah. So it's a very, very different picture.
Give the young 25-year-old associate who's working in Midtown Manhattan, who's a believer, give him a charge, give her a charge, give some attitude to them on just say, hey, take what you believe to work. Don't just obviously, proselytize everybody.
Correct.
But how can you take what you believe to work and be on mission in the workplace while also, being a good steward of the job that they have?
It's a lifestyle. It's a way of life. Let me say it this way. I can remember early on in my career, I want to share my faith with Joey. And it just kind of never happened. And I said, because I'm trying to make it separate. It needs to be part of life. So I did two things that made a huge difference. One, if you asked me on Monday morning, what did you do this weekend? I would always answer the question with what I did that was unique that weekend. And instead, I said, I'm going to add, and I went to church, assuming I did, which I do most Sundays. The second Sunday in a row, where the guy asks, wait a minute, did you go to church last Sunday? Do you go to church every Sunday? What a teachable moment. The other thing I did was, particularly when you're a CEO, people come with all kinds of problems, work problems, personal problems. And as they were leaving my office, I'd say, I'm going to pray for you. And I make a little note, and I would pray for them on whatever that issue was. If they dared come back a second time, which most of them did, can I pray for you now? No one ever said no. No one ever said no. So now this fictitious Joey, he's right in front of me. I get to talk to the God I want him to meet about his problem. What a beautiful thing. Yeah. So I'm saying to that mid-20s Manhattan, Midtown Manhattan, just figure a way to make it your life. Don't be contrived. Just ooze it.
I think the other thing that comes up there that as Christians we sometimes lose sight of is it's really God that's bringing us to belief. It's not us. We're simply the witnesses that are being used. And I think sometimes that 25-year-old feels, okay, in some way I've got to start adding names.
Yes.
And some of those names you find can be very valuable, but it's not until 5 or 10 years down the line, or maybe more for that matter.
Right.
Yeah, I think what's interesting, got obviously tons of friends who are in that role. That's why I asked the question. I think one of the other things I would love to get your perspective on, did you have any older men in your life that were great stewards of their time and resources that you looked up to, either in the business world or as pastors?
Yes. I'm on the board of a liberal arts Christian college, and they got a new development director. Cairn University. Used to be Philadelphia College of the Bible, then Philadelphia Biblical University. They got a new development director, and the guy said, I know how we're going to raise money. We're going to get Bob's Rolodex. And Todd, my friend, the president, said, Bob's friends are all pastors and missionaries and college presidents. So they're the people I gravitate to. I guess what I'd say is yes, examples along the way. One that just sticks out that pops into my head, a couple, when Leslie and I, my wife, we were in our 20s, and they counseled us and said, you're working on Wall Street. You're probably going to make a whole lot more money than you ever thought you would, which, thank the good Lord, we did. And they said, when you get a bump, think about capping your lifestyle. So when God grants more, it's not to increase our lifestyle, it's to increase our giving. And that was just a wonderful example, and we followed that. And don't feel sorry for us. We have a nice house, we take nice vacations, but we're able to be generous to God's people.
Okay, let's get into the market.
Sure. So how do you
buy
see
low, sell high?
It's easy.
Any questions?
Yeah.
Yes.
So how do you see the market today? And I'll start with that first question that I asked a while ago is, should people be looking at managed or passive? That's the kind of
Let me start with that
whole
one.
argument right now. And it's shifted over times too, because you'll sometimes see, well, managed is coming back into play. Then you'll move back toward passive.
In the last 10 years, passive has cleaned the clock of the average active manager, period. So you have to ask the question, why? And might that reverse? A lot of it has to do with equal weight versus cap-weighted portfolios. When the average stock is underperforming the averages, and we've been in that mode for quite some time, the mega cap, the Mag 7, are leading the way. Sure. The average stock is lagging. Managers tend to be more equally weighted than cap-weighted. So that's a noose around their neck. And so we, myself included, we have underperformed. My guess is we're heading into a period where that is going to reverse and the average stock's going to do better than the benchmarks. It'll take several years of that before anybody
thinks. Better than the benchmarks or better than that heavily weighted Mag 7 at the top?
Both. You know, for the index, for the average stock to beat the index, the Mag 7 are going to have to underperform. And I'm not against the Mag 7. I hear a lot of comparisons to the late 90s and .com, et cetera, et cetera. So let me make that comment. These companies, the Mag 7, they have revenues, they have earnings, they have cash flow. Unlike late 90s into 2000, where there were no revenues and earnings. It was price to clicks, price to eyeballs.
Absolutely.
And very different pictures. So I'm not saying don't own those stocks. I just think you have to be careful which ones. It's not just own all of the Mag 7. So go ahead. I was going to come back to you said, what do you think of the market? I believe we are in a high risk bull market. The bull market part means path of least resistance is higher. You got to be involved. The high risk part says, but be careful. Be careful what you own, and don't take a 3-month hike somewhere where you can't be in touch. Why is it high risk? Valuations are very high. A lot of speculations crept in. Margin debt, pop prices and IPOs. The average IPO from its offering price is up 35% on the first trade. That's better than any time since the year 2000, which was not a real good period to be in the market. SPACs are back. So there are lots of signs of speculation that tell me just be a little bit careful. You can't call the top. Valuation is not a timing tool. Right. It just gives you a sense of risk reward. So if something fundamental does come along that's negative, that overvaluation could mean the decline would be bigger than if it wasn't overvalued.
But as kind of a asterisk of full disclosure, anybody that thinks they can play the timing game of getting in and out, that's a big cemetery.
Yeah, well, in a bull market, we all think we're geniuses.
So when does it go to a bear market? What would cause that?
The economy slowing down and earnings disappointing, which
now,
doesn't seem
earnings have actually been
awesome.
Yeah, much more positive than you would think.
Awesome. First quarter was off the charts. Second quarter looks like the third quarter earnings. Of course, we're about to start reporting them. Are probably going to be pretty good. So if the Fed is easing, which they are, and earnings are good, markets almost never go down.
Should the Fed be easing, Bob?
How many hours do you have? I think, yes, to a degree. I think we'll get one more cut this year, not two. The Fed's job's always hard, but it's gotten harder.
Absolutely.
Because they're supposed to keep inflation down, and it's creeping higher. Yep. They're supposed to keep a lid on unemployment, and it's creeping higher. And that's why you have a divided Fed. I think we're going to hear a lot more noise about the arguments they have. The doves say, don't worry about inflation, just fight this jobs problem, lower rates. And the hawks say, not so fast. We have a target of 2% inflation, and it's 3% and rising.
And my sense is the former group has never lived through an inflationary environment.
Well said. There's a man who knows his history.
Were they late?
Yes, they were late. Yes, they were late.
How late?
A few months. You'll recall we got that employment report, the monthly employment report in early August. Mm-hmm. It was awful. Yeah. Had they had their meeting post that rather than pre that, my guess is they would have lowered rates then.
Got it.
And probably more to come, but it's getting tough. Then you throw the politics on top of it, of the president who wants to control the Fed.
Is the Fed independent? Is it still independent?
Yeah, most days. I think the Fed's still independent, but we're gonna test that. We're gonna test that. We need an independent Fed.
Yeah, no.
And if we don't have one, there can be a lot of problems. Most especially the dollar will go like that, and it's already gone down some, as you know.
But a great question is, can the Fed even be effective in today's environment?
Yes.
And for real reasons, not some, and those are valid ones on independence and that sort of thing. But we've seen debt in the United States shift notably from the consumer and businesses, where the Fed can touch those rates, and that has a direct impact, to the federal government, state governments, pensions, et cetera, public side of it. So changing the rates on that side doesn't have near the effect that it did with businesses and with consumers. We also are seeing a situation with the economy in general, of the ability for the Fed to change that balance sheet becomes at best more challenging.
Correct.
In that scenario. And then the thing I'm going to really push you on is you got this thing called the deficit. So not only the debt where it kind of lays out in the economy, But it seems to me more and more, at least the long players, when you're getting out longer term, they're starting to kind of say, maybe there's an issue with this deficit and it's finally gone to the point where it doesn't go. Because we've gone for a lot of years, and I've heard it, and to be truthful with you, I've been one of them, that's on the public side said, this debt is unsustainable, can't do it that way. But the reality is we went for good over a decade.
For a long time.
Complaining, but it really didn't have an effect.
Correct.
Is it starting to have an effect, I guess, Bob?
I think it is, and my one data point is since the Fed did lower rates, as Kyle mentioned, long-term interest rates have moved up. Not down.
Yep.
I think that's the bond vigilantes waking up saying, guys, you can't keep doing this. We just crossed, as you know, $37 trillion of debt. The estimates are by 2055, it'll be $100 billion if we do nothing.
100 trillion.
100 trillion. Did I say billion? I wish it was only billion.
I wish it was 100 billion.
It's still a lot, right?
Exactly.
Actually, people would argue this well over that now if you do a roll.
If you put the whole
all the
balance
numbers.
sheet. Yes. My view, having studied this but still being a novice, is there's only one way to solve it, and that's the entitlement programs. Social Security, Medicaid, Medicare are crowding out everything else except interest expense, which is going faster than anything else, and now has eclipsed defense spending. So we're going to have to look. If any of us,
isn't there another way of dealing with it?
Tell me.
And
I think we ought to elect him to office. What do you think?
Well, no, you're not going to like my answers. Probably nor do I. So you've had the president, and for all practical purposes, we've seen Congress take the same position. Entitlements are the third rail. We're not going to touch them. We all know, but we're not going to touch them. It seems the other way to deal with this is you have an enormous inflationary period of time, which in effect then reduces the debt.
The real debt.
It stays at 37 trillion, but all of a sudden the dollar isn't worth, that 37 trillion isn't really what the numbers are anymore. That comes with an enormous cost.
Absolutely.
To not only the economy, but individuals within the economy.
And the U.S. position in the world.
Yeah.
So,
the strength.
Exactly. So we look out there, you said it's important. We can deal with entitlements. Yeah, I wish we would. Not a great possibility of that. And then you got the inflation. Where else do we go, Bob?
They're the only two possibilities. Here's my, and maybe I'm being a cockeyed optimist. America solves its problems, but only about 10 minutes before midnight.
Mm-hmm. The Winston Churchill line.
Yeah, he's right. So look, right now, if a politician raises his or her hand and says, I know how to fix this, I'm going to cut the entitlement programs, they lose immediately.
Yeah, they don't win.
At some point in time, when we are struggling to grow, when inflation's going like this, when the dollar's going like this, there might be a politician comes along and says, I know how to fix this, cut the entitlement, and we're going to say, there's the man, there's the gal, and we elect that person. I don't know when the day of reckoning is, but it you know this, when you look at the entitlement programs and how fast they are growing, they're crowding everything else out. They got to be cut.
Well, and then
for the audience, when Social Security was put in effect, we had this many workers and this many retirees.
Well, retirement age was 65.
Yes, and people died at 66.
64.
64.
It was actually life expectancy
was less than
was slightly less than retirement.
There you go. Now we retire at all kinds of ages and live to 92. Can't afford it. We cannot afford it.
So you're a Northeast guy, New Jersey, New York. Do you see the rise of Azora Mamdani being a reckoning on the lack of, wage growth over the last 40 years, and now making these, what I would term absurd claims about government involvement in the economy, price fixing, grocery stores, you name it? Is that a reckoning?
You don't think the government can run grocery stores?
Yeah. I'll let you shop there, Tom. Is that a reckoning on the lack of wage growth and really only seeing the top 1% to 5% in this country?
Yes.
Really?
Yes. It's
excelling.
The average younger person typically. Sure. They earn this much. Their inflation rate is this. They can't keep up, and they're saying, "Here's a guy that's going to give me some stuff for free. Let me give him a try because the other didn't work."
Sure.
Well, what's fascinating to me on that is, I was thinking about this, and we kind of touched on it, but we didn't get there. what you're seeing is there's a real pushback on the elites. Mm-hmm. In one case, it's exactly this. It is the young folks in New York that are sitting there saying, okay, I can't afford rent, et cetera.
Yep.
So I'm moving towards socialism. It seems to me that there's also a group in, I'm generalizing, but bear with me, in kind of that Pennsylvania, that Alabama, Pennsylvania area between Pittsburgh and Philadelphia, the rural parts of Ohio, who's saying, this doesn't work, I've been left out. And they're really running hard to the right.
Mm-hmm. Absolutely.
Yes. But I think they're attacking the same
it's
group.
the same issue.
Yes.
But I think it just is, and it's gone both extremes.
Yes. Polar opposites the other way. Yeah. Yeah, it's going to be interesting to observe.
Longer term then, you said earlier, it's a bull market.
High risk.
Getting expensive.
So
caution time and that sort of thing. Are you still optimistic about the U.S. economy longer term?
Reasonably so. I don't think we're going to... How do you grow an economy? Change in the size of the workforce multiplied by its productivity. Change in the size of the workforce has a lot to do with the population. We are not making enough babies in this country. We need immigrants, legal immigrants.
Yeah. But to be fair, nor is any other country.
No other developed country.
Well, it's interesting. Even now you're starting to look at birth rates in China and India, and they are not
correct.
They are not going to sustain
Africa,
it.
you're still having this.
Africa,
parts
you are,
of Asia
but,
going
but,
the poorer countries.
China, India, yeah.
But China and India, absolutely.
Yeah.
China especially. Demographers estimate China's population at the end of the century will be half of what it is now.
Yeah, there's actually projections that go out a little bit beyond that has the United States population, assuming what you're talking about, immigration going forward, and China, that they'll actually pass.
Bingo.
Bingo. Now, again, you got to go out a ways in your numbers somewhere in the 650 million range. But
so there's one argument to say the returns are probably going to be more muted. Let me give you a simpler one. If I could show you my slide presentation right now, I'd show you the slide that has all empirical information. It looks at when the PE ratio of the stock market, the valuation is 10 to 12, 12 to 14, all the way up to above 20. What is the subsequent 1, 3, 5, and 10-year returns? And the answer is on that 20-plus row where we are today, PEs are 22, 23, returns are 3, 4, 5%. Total return per annum, including dividends. So if you ask me, what do you think stock's going to do in the U.S. in the next 10 years? About 5%.
So then does that argue for, and you've seen an enormous amount of money go into private credit, those sorts of deals. So equity versus credit. Does that push people over to the credit side and away from the equity? So you're weighting that old traditional 60, 40, 70, 30 shifts now?
For some time and for some people, yes. But here's my monkey wrench in that. Lending this cycle took place largely outside the banking system. Private credit.
Yeah, exactly.
Kyle and I see an empty piece of property over there. We're going to put a building on it. We go to our local banker and they look at the two of us and say, are you kidding? We call our private credit friends and they write us a check. Yeah. A lot of that's happened. So I think my wet blanket on that is I think private credit's going to have a lot of credit problems.
It's kind of a reckoning.
When we have the next slowdown / recession.
So there's still a lot of money out there. Where does the money go then?
Yeah.
So 3 to 5%, I'm not too far above risk-free treasuries at this point.
Correct. Which means those rates have to come down too.
So where is money going to go then?
Yeah, it's gonna accept lower rates of return. All these vehicles it will go, but it'll be harder to. I mean, there are only two ways to move stocks up: higher PEs or better earnings. Profit margins are at all-time highs. They're likely to stay higher than normal because of AI and other productivity measures, but the PE is not, I don't think, going from 24 to 32.
Okay, we'll simplify the globe. There's the U.S., there's Europe, there's China, and then there's developed. Do a compare and contrast of those four investing opportunities and where you see those.
Let me be simple to start. I see a lot of U.S. individual and institutional portfolios. Most of them are, 2% non-U.S., 1% non-U.S., maybe 4%.
Yeah.
So the first thing Americans need to do is think about, do I really only want to invest in the alphabet from kind of A to M and ignore the rest of it? That's what you're doing when you ignore the rest of the world. Now, in the last 10 or so years, it's been exactly the right thing to do. But given the valuation differential, And the fact that central banks outside the U.S., particularly developed countries, have been lowering rates, we'll get a little better growth out of there. So I think you just need some diversification. And then if you agree with me, returns in the U.S. are going to be more punk going forward. You need some geographic diversity. So the areas you just talked about, China's hurting.
Mm-hmm.
China's hurting big time. The debt problem and the demographics that you alluded to. India has some more juice left. Population is still growing, but we'll get to the point you mentioned. They need to do some banking, financial system reform, and they're working on that.
Yeah, I was going to say, kind of the infrastructure is still pretty limited.
So I think they'll have some future. And then Europe will kind of just tag along.
I walked through that, and I'm still left with, okay, Europe has clearly moved to socialism.
Yep.
That's not going to encourage returns. You would think you did a good job of identifying some of the long-term investing issues, at least in China, plus probably an autocratic environment that has never shown an ability to this point to have innovation, creativity, and that sort of thing.
Yep.
Developing is it. Aren't you still left with, when said and done,
back to the old U.S. of A?
U.S. is still in the best position?
The answer is that, and that should be your largest weight. But I'm not saying, I'm saying not 100%.
Not 98.
Yeah. Think about, if you're at 5, go to 10. If you're at 20, I wouldn't go to 40. 20 is a good long-term number. It still overweights the U.S., which is the right thing to do, but not zero outside the U.S.
Considering the U.S. is roughly a quarter of the U.S. The world economy.
Correct.
So let's talk about an issue that's central, I think, to younger folks right now: housing.
Yeah.
We're clearly in a housing issue. I don't know if I want to call it a crisis or not, but we're in a
pretty close
significant situation on housing. Obviously in North Dallas, and Dallas seems to be like the boomtown. It's just been up and to the right for the last 10 to 15 years. The rest of the country does not feel that. And so talk to me about how a younger generation should view this housing market and not be discouraged, or should be discouraged, as it pertains to the future of home ownership, which is a great equity creation source in this country.
I wish I could pound the table and give you a big, bright, bow and a ribbon on the whole thing, but I can't. House prices are high relative to virtually everything. I don't see that changing, and they'll come down some. We talked about interest rates out the curve. Fed lowers rates and the rates move up, and mortgage rates are long-term. They're going to stay stubbornly high, in my view. So if prices are reasonably high and mortgages are expensive, housing's going to bump along and struggle. And I think we're in that for a period, certainly for the balance of this economic cycle.
I don't think young people also realize that over the course of the last couple of decades, and young people are wrong in reason, have really wanted to move into metropolitan areas.
Yeah.
But those metropolitan areas, housing has been limited by the government.
Yes.
So anytime you limit something, you're going to push the price of it upwards and upwards. Now, if you're it's the musical chairs. If you're sitting, it's a terrific deal.
Yeah.
But if you're just getting into the economy, that's a bad situation because you're forced to buy high off of inflated prices. And when the government starts easing that up, if they do, and puts more housing units, you're going to be the most vulnerable.
Yeah. That's right.
Fascinating. Where's the market in 5 years? Where do you see it being? What's the economic cycle? What's your forecast? Give us 5 years out.
I think the economy will have, in the next 5 years, at some point, a recession. And I think it will be a mediocre recovery and slow growth. Back to the way you grow an economy, the inputs to it are going to be mediocre. Not bad. It's just slower than what a lot of people, when they study history, think, well, I guess we're going back to a 3 to 4% growth rate. I don't think so. Which then says stock prices will go up, but by this much, not by this much.
One more question on the vision here. How does AI affect any of it, all of it, none of it?
Big time positive. No question about it. I don't know where we'd be without AI. It's making up for the population absence of growth that we struggle with. It's creating some productivity. We've been in this business cycle a long time. It's long in the tooth, but AI has extended it. And AI is for real. Now, as it relates to the stock market, when something like this comes along, the stock market generally gets it right, but it overdoes it. And so at some point, we'll have a noticeable pullback because the impacts are not like that as much as we'd like. It's a period of years. It's going to take time.
But on AI, does that eliminate wealth managers? Does that eliminate a large piece of your business? By literally saying, we will manage portfolios through AI.
Yep. So I've got over 50 variables in the little quantitative model I talked about. 6 of them are AI. So we've incorporated mostly machine learning.
Give us a feel for what those 6 are.
Machine learning. Machine learning simply is look at the patterns, see what happens, how do you extrapolate in the future? That's what they do. And they create alpha. So
but what do those 6
variables?
Like? But what do those 6 look like? Is it a company of how effective the company is using AI? Is it their R&D in AI?
It's AI looking at all the variables that move a company and an economy, identifying patterns.
So it's AI down to company, not company up.
Correct.
When did you put those in?
Started, 6-8 years ago. It wasn't even called AI. It was just called machine learning.
Yeah.
And every time we find a little something new, we put it on in there to create a little more alpha.
Fascinating.
Yeah, it is fascinating.
So where does your business go though? Not where the economy goes.
Yeah. So if we are in a period where the index funds continue to outperform, there'll be fewer and fewer active managers because people will index and say, what do I need to pay an active manager for? If my premise that they're going to start doing better, it'll remain very competitive, but we'll still be in business. And then if you take the faith-based money management is growing as a percentage of the total from a very small base. And I think given the dynamics of faith in the U.S., I think it will continue to grow.
Save the deficits, though. We haven't really spoken about the importance or the impact of government policy.
Correct.
We've seen over the last 6 months, lots of changes in that, tariffs, et cetera, those sorts of things. Talk a little bit about how you see, and maybe even within your 50 variables, where does government policy and government action fall into this equation? And what's generally your reaction to some of the things that the administration is doing relative to trade and relative to investing in terms of loosening up even issues related to we're not going to do quarterly earnings anymore.
Yes,
we want to go to 6 months.
Right. So, boy, we could talk for hours on this.
I threw too much in there.
No, it's all right. It's all right. I'd start by saying, and we need to remind listeners that we have a big tax bill that starts on January 1st.
You got it. Huge one.
Thank goodness. I mean, it's not a perfect bill, and we would probably all 3 of us held our nose but voted for it because this bill is better than no bill.
The big, beautiful bill.
Yes, that's big, beautiful. Had we not passed that
oh my gosh,
on January 1st, we would have the biggest tax increase in U.S. history and almost definitively a recession. So this gives us not only avoid that, but it's going to create some growth. The incentives for businesses on capital expenditures, it's hardly been talked about. It's massive. So this will create, at perhaps a time when the economy is naturally slowing, a bit of a growth pattern.
And that outweighs the additional deficits that come along with that?
It will help. It will help. That along with the tariffs. Tariffs are bringing some money in the door. Look, when Donald Trump was elected the first time, he didn't think he was going to win. So he had no plans, no people.
Correct.
The second time, he knew he was going to win, and he had all the people lined up, and
he had 4 years to plan.
Well, it did, and he's sort of done 4 years worth of work in less than a year. I mean, he's put a lot of stuff in place. And most of it, not all of it, but most of it market friendly.
So how influential has Secretary Bessent been?
Very much so. We are thankful for him. Mm-hmm. He's the real deal. He understands it. He can talk. I am told that when the president goes off course a little bit, Scott can walk into his office and say, Mr. President, he doesn't say it this way, I'm sure, let me educate you. Yeah. and convinces them that was not a good idea or think about doing it a different way. So he is the adult in the room. Right. We are fortunate to have him as our Secretary of Treasury.
So on whole, do you think the administration policies, the way that they've taken them to date and the way they've laid them out of what we can at least reasonably expect over the next 3.5 years is going to be positive for the market?
Yes. Not all of it, but on balance.
Generally, yeah.
In fact, you guys may know I do these silly 10 predictions every year. And number 9 was Trump's policies on balance are market friendly. And I'm going to go through a bunch of pieces and score more positive than negative. By the way, the 10th prediction was Doge makes progress, but falls woefully short of
For sure.
Elon Musk's, we're going to save $2 trillion.
You probably need to have 2 woefullies before you get credit for that one.
The truth.
Okay, but hold it. We're sitting here. We are beginning the 4th quarter of the year tomorrow.
Yes.
So predictions in 2026 are not too far away.
No.
So what are some of the big ones we ought to see from Bob Dole?
Oh, I never, honestly, I start making notes around October 31st, ripping out pieces of research, underlining things. And by the 2nd week of December, I have a pile like this, and I tell my assistant, no meetings, no calls. And I go in my jeans and my flannel shirt, and I begin to sort, and out of that comes some predictions. So I have no idea.
So we're going to call you at the end of December.
Yeah, right. We literally release them on December 31st.
I love it.
I get them done 2 weeks before that, but do all the collateral material and get the compliance people to say yes. It takes a little while.
They do get a lot of visibility.
Don't they? Oh, the predictions. Yes, they do. Yes, they do.
I'm going to flip the script on you.
Yeah.
Last question, and then we'll wrap.
Yeah.
Was it worth it over the last 4 or 5 decades in your career? The sacrifice, the time, the energy.
Was it worth it?
The thought process, the issues at BlackRock, the moving firms, all the things. Was it worth it? And what has God taught you through all of it?
Yes. What pops into my head is, I don't know, 20 years ago, I was stranded in St. Louis, snowstorm. And I was kind of blue. I wrote to my 3 kids. I think we had BlackBerries at the time. And I said, I'm sorry that I have not been there for boom, bada, boom, bada, boom. Sorry I have not been one of your best friends, et cetera, et cetera, et cetera. So, a lot of sacrifice. I traveled a lot, trying to climb the ladder, doing, So I tell people, as another aside, that my wife, an amazing mom and half a dad, and I'm the other half a dad. And that's about the truth. I got 3 letters back. I still use them in speeches from time to time for my kids. Dad, if you had not been there for, can you think about this? And it was
the ones you were there.
Yes. So was it worth it? Yeah. What's God teaching me? To depend on him. I don't have the answers. He does. And we can trust in his ways.
I wish more people understood that.
Amen.
Great. Cool. Thank you. Thanks for making the effort to
Bob,
be here.
Thank you.
So fun.
My privilege.
Very much
You guys are great. All the best.